We're back again with another great episode of PFREI, Passion for Real Estate Investments. I'm your host, Fuquan Bilal. Today we have Kim Butler, founder of Partners for Prosperity. This is an interview I've been waiting for. Glad that you found the time to join us on the show. We're going to cover a lot today. Got a little different spin than the usual podcast. Kim has shown common financial products such as stocks, bonds, savings accounts, and CDs in favor of alternative investments, private lending, and creative life insurance strategies outside the typical financial planning box. So it's all part of the prosperity economics movement, which we'll talk about, a nonprofit organization co-founded by Kim along with her husband, Todd Langford, a financial software developer who's always checking the math, which spread its wealth without Wall Street. We'll talk about that also. I like that. I might have to use that, Wealth Without Wall Street. They have a mission to create clients and other advisors alike. So Kim, welcome to the show. Really appreciate it. It's an honor to have you on. I get all of your great content, read a few of your books. You have so many. I'm like, wow, I didn't have 3 books. She has like 100 books. But it's all great information filled with powerful content. So welcome to the show, and let's just talk about a little about your background and how you went from, as I mentioned, and you hit another word, I forgot what it was. I said traditional investments, the stocks, to shifting over to alternative investments. Let's talk about that a little bit.
Right. So the word that, well, first of all, thank you. Love to be here. So happy to help and chat with your audience. The word that we have come upon is typical, because the work that we do is traditional. If you think about real estate, whole life insurance, alternative investments, those things are traditional. They've been around literally since the beginning of time. I mean, if you go back and read even books like The Richest Man of Babylon, they talk about essentially real estate, and they even mention the idea of life insurance. And then of course we do bridge loans and private lending, that's been around forever. So that's traditional. This whole stock bond mutual fund thing, all of the financial planning environments, literally only in our public since the 60s and 70s. Now I realize the stock market was around a little earlier than that, but people didn't get involved in it until the 401k came about and until the College of Financial Planning out of Denver came about. And that was in the 60s and 70s. So we call it typical.
That's awesome. Thank you. I appreciate that. You mentioned one of my favorite books, The Richest Man of Babylon. So part of it says, a part of all I earn is mine to keep. Right? I think that's right. Right? Yeah, that's it. Right? Yeah. And a 10% thing. So I get that. Big fan of that. Let's talk a little bit about the traditional types of investment. There's private lending. Are these things that you try to tell people to do from their IRA account, or what type of structure do they need to have to create that wealth without Wall Street, so to speak? I know you also teach about the insurance process also. So let's jump into that.
Absolutely. Well, in fact, I'm going to tackle the insurance first super fast, because it's critical that people have emergency funds. And holy cow, in 2020, have we ever seen that? I mean, personally and business-wise, people need to have emergency funds. And so the whole life insurance product is the perfect place to store what I call emergency/opportunity funds. Because if you don't have that emergency/opportunity fund, first of all, you shouldn't be investing. Let's please save money first. Go put it in a bank, bury it in the backyard if you want to. But have savings, liquid savings that you can, here's my little acronym that's in the books: control, liquidity, use, and equity. Have savings that equals that clue: control, liquidity, use, and equity. We can come back to that if you want, about how the life insurance supports that. But have that savings first, and then go on to your opportunities, because the opportunities, so now to answer your question, are literally unlimited. And maybe an opportunity is investing in yourself and an idea that you have. I talked with a young kid the other day, and he said, I just want to save up a little extra money to do Facebook ads on this idea that I have. Awesome, go for it. Or maybe the opportunity is a lump sum, 50 or 100,000 into like a bridge loan or a life settlement or one of these private equity deals that requires a lump sum. Well, our lives don't work in lump sum. Our cash flow is usually monthly. And so the life insurance is a great place to save up monthly so that you can then go take advantage of that opportunity of 50 or 100 grand or $1 million down payment on a $10 million apartment building. I mean, cash flow problems don't go away. They just get bigger zeros on them.
Absolutely. Now, how long does it actually take for someone to build that structure with the life insurance where you can actually borrow against it and go through that whole process? Let's talk to the audience about that, because some people aren't aware. You really have to double down and invest a lot of dollars into it, correct? In order for you to accelerate it faster, to be able to use it for what you want to use it for, to borrow money from it. And you're your own lender. You're borrowing money and you're paying yourself back at 5% or whatever it is back, and you're earning interest on that. Let's talk about that a little bit. How do you accelerate that? I'm pretty sure that it would take longer than the session that we have here for you to develop a plan to figure out where they are financially and how fast they can build it. So let's talk about that a little bit.
Well, it's interesting. Life insurance is very age-based. And so if you're 20 or 30 years old, you can absolutely start with $100 a month, $500 a month, $1,000 a month, something like that. And you don't have to have a lump to get started. It absolutely does take some time. The product is called whole life insurance, and it's because you're going to use it your whole life. And nothing good that we're going to use that long is going to happen overnight. So I would say the general starting time frame is usually around 2 or 3 years. It's really not as long as people think. I mean, we can do it as early as sometimes the 7th month, the 13th month, depends on the company. But again, remember, the first job of that life insurance cash value should be to store your emergency fund. So you really want to get that built up too. Well, for some families, 10 grand is an emergency fund. For other families, 100 grand is an emergency fund. For businesses, 500 grand is an emergency fund. And of course, they're going to have corresponding capability from a cash flow standpoint. So then once you get ready to take advantage of opportunities, I want to connect a little bit on some of the language that you used, which is out there in the marketplace and incorrect. So first of all, we're not borrowing from the cash value. We're not borrowing from ourselves, though that is a common word and I can see why it's used. But let's get crystal clear on this for your listeners so they understand exactly what's going on. They're borrowing from the life insurance company against their cash value. And so I really work with my clients, and I make the mistake too. I say borrowing from your cash value. No, you're borrowing against your cash value. Just like real estate. You borrow against a home. You borrow against a apartment building or a commercial building to go get your mortgage or whatever it is. You're borrowing against that. And it acts like equity, right? The piece of real estate keeps right on growing unaffected by the loan. If you have an apartment building on one side of the street and another side of the street, one has a mortgage on it, the other one doesn't, they both still grow at the same pace unless, something on the other side of the street is way wrong. Yeah. They're going to grow because they're in the similar area. Well, life insurance is the same way. Cash value of life insurance grows unaffected by the loan. So when you've borrowed against it at 5%, that's a pretty good interest rate. 5 or 6% is pretty normal right now. And then you go invest in your real estate deal that's earning, let's just use easy math. Let's say you're borrowing at 5 and you're investing at 10. Well, that's doubling your money. That's a 100% rate of return because you as the investor, the only money that you had in the deal is the interest cost on the loan. It's the life insurance company's money that made the down payment on your real estate deal that then, got you your 10%, or maybe you lent it as a private loan or as a bridge loan and you got your 10%. Your cost is 5, your gain is 10. That's 100% improvement.
Yeah, that's a nice arbitrage. A lot of people don't know that they can use those creative strategies and create arbitrage. They can do a variety of things. I mean, you can do wraps. There's just so much that is. I had someone else on a podcast yesterday. We were just talking about just the different types of strategies you can do with real estate. Are there other types of asset classes, such as precious metals or other things that you teach people to invest in, or is it just real estate based?
So a couple other alternative investments that I do like, and then I'll address why I don't care so much for precious metals. So the private space, private equity, oil, gas, life settlements, this is all a very substantially supported traditional space. It's been around for a long, long time, well before any of the public markets ever existed. And so, oil and gas, kind of, a lot of people know about that. Let's talk about the life settlements. That's not as well known. Had you heard that term before?
No, I haven't heard about that as an alternative investment to invest into.
And you asked earlier in the podcast, do we do this with IRA money? Well,
yes.
Self-directed IRAs, and I'm sure you've had a lot of people on your podcasts around, trust companies that provide self-directed IRAs, pretty much enable people to invest in all of these types of things that I'm talking about. So none of them are limited. It can be either cash after-tax money, or they can be IRA money. And the nice thing about the bridge loans in particular and the life settlements is they don't cause self-directed IRAs to have tricky tax issues, because as your listenership knows, if you invest directly in real estate with an IRA, there can be some problematic tax issues there. So the life settlements are one of my favorite places to put IRA money, because IRA money is typically growth oriented. It's typically long term, and those things work very well with senior life settlements. So what that is, and it doesn't matter whether it's your IRA that's buying this or your after-tax money, is you purchasing, it's often done in a fund, somebody else's life insurance death benefit. So this is not about the cash value, this is about the death benefit. And the people that sell these have been typically diagnosed with one or two terminal illnesses. They're typically in their late 80s and 90s. And this is not the 90-year-old that's going to live to 120. This is the 90-year-old that's likely to pass on in the next, say, 5 to 10 years. And so you as an individual or your IRA is purchasing typically, again, into a fund, which is buying maybe 10 or 12 of these senior life settlements. And this is also a traditional investment. This has been in the tax code since 1913.
I'm taking notes.
I love it. Good. Yeah, the life settlement, the first case that the Supreme Court actually heard, so you can tell how high it went, it was in 1913. And I'm blanking on the name of it right now, but it basically was a person that wanted to sell their life insurance policy and was told that they couldn't. They're like, wait a minute, it's an asset just like anything else is. And so he took it all the way to the Supreme Court and he was able to sell it. And again, what he sold was the death benefit, not the cash value. So again, I reiterate, this is only for people in their late 80s and 90s that are ill. And from an investment standpoint, you have two guarantees there. You have guaranteed death. We don't know the time frame, but unless you know something I don't, death is a guaranteed event. And then you have a guaranteed payout from well-known, huge, ancient life insurance companies. So you think about any life insurance company that you've heard out there, the mutual companies like Guardian, New York Life, Mass Mutual, Northwestern Mutual, Penn Mutual, Ohio National, all of the mutual life insurance companies. And then you think of all of the stock life insurance companies, John Hancock, Prudential, MetLife, et cetera, all of those are essentially household names because they're all, most of the cases, over 150 years old. And they're all highly, highly rated by all of the rating agencies. So you combine that guaranteed death payment from the life insurance company with a guaranteed death of a person, and the only unknown is the time. And so again, 7 to 10 years, 5 to 10 years is your time frame, and very, very nice returns. And, it's interesting. So I'll pick up here on why I don't like precious metals. It's pure speculation. Now, if you want to have, 10 grand of gold coins in the safe, or the bottom drawer of your closet, because that makes you sleep at night, awesome, have at it. But from an investment standpoint, pure speculation. Now, if you have the wealth to speculate, go for it. However, most of America doesn't really have the wealth to speculate, although they do it all the time, because I think the stock market is speculation too. I am way more interested in something that I can get my hands on tangibly, which we could argue that precious metals is, but then what now? Like, how am I going to sell that, right? And a lot of times people want precious metals because they're afraid of what's going to happen in our economy. Well, if our economy goes really, really crazy, you would be wiser, in my opinion, to be more concerned about food on the table and drink. So go buy a bunch of bottles of water, right? Go buy a bunch of food that you can store. That is a much wiser purchase in my mind than gold in the, in a bar or a coin that I'm going to throw in a safe and somehow feel more confident about that. And then let's define investments as something that ideally is not going to lose principal and can earn us a decent rate of return after taxes and inflation. And, everybody has their own definition of decent, but that no loss of principal is critical. And speculation causes loss of principal. Investments shouldn't.
That's a good point. I'm still actually stuck on a senior life settlement. So I'm like, wow, just learned something. So that was all great information. I really appreciate it. I have tons of notes here and some questions, which we probably would do another time offline. But just to talk back on the senior life settlements, that is a very unique investment strategy. You said mostly funds do it because I would figure they sell off of a percentage of a face value. And, you can get it at a discount, and then that's how you're going to make your return. And then I'm thinking, okay, now how do could you like put a collateral assignment on it and then leverage it? Like, my mind is always going down to the end of it. So I got to let it say no. So that's a great alternative investment. Is that something that you're seeing that you said most funds are putting together with syndications or like, closed-ended funds or open-ended funds and creating that 10-year, 12-year term? People are investing in this, and the typical people that are investing in this, they're doing it from the IRA account, which is long-term. So of course, they're not going to get any distributions until it pay out, something like that. That's the type of structure you're seeing with that?
Correct. Not typically syndications. They're more private, unregistered securities, and they are for accredited investors only. And so it's an area that's fun to learn about because a lot of people don't know about it, and maybe you're not an accredited investor yet. We certainly have some alternative investments that fit the non-accredited investor as well. But the senior life settlements are such a nice place because we can be so assured of those payouts in the future. And as you indicated, it does not create income. So it's not a good place for IRA money for people that are over 70 and a half, but it's a great place for IRA or 401k rollover for people that just want the money to grow and can't touch it anyway because they're not 59 and a half, or maybe they are, but they want it to grow another good 7 to 10 years. So senior life settlements are going to be more and more common. I think it's been, I've been working with them for probably about 15 years or so. I think they've become more public or more known in the public just in the last 10. And it's largely because a lot of funds have opened themselves up to what we would call private, but still retail investors, whereas they used to be only on the wholesale side. Only the huge hedge funds could get into them, $5 and $10 million minimums, that kind of thing. Whereas now it's all brought down to a more normal level, $50,000 to $100,000 minimums, again, for accredited investors, and yet a space that the normal American could get a hold of. I don't know if accredited and normal American fit in the same category, but it depends on your listenership. It's something that many people are accredited, just in case they're not aware of that. It's $1 million net worth, not including your home, or $200,000 to $300,000 of income, $300 if you're married, $200 if you're single.
Absolutely, absolutely. So I love the mission, Wealth Without Wall Street. I see all the content that you're putting out, all the books, and you're educating the masses of what's available to them, right? A lot of people don't know. A lot of people are not privy to this information. They don't do the research. So the podcasts that you do and the books that you write, they're really, really good. Let's get back to the clue. Let's talk about that a little bit.
Sure. So that's an acronym that I came up with long, long ago for my very first book, which is called Live Your Life Insurance. I think there's about 8 Fuquan on Amazon, not 100. Thank you for saying that I have 100 books. We do have another one coming out around the holidays that I'm really excited about. And so I think that'll be our 9th. But anyway, CLUE stands for control, liquidity, use, and equity. And so C, you always want to look at the control. It's kind of like an opportunity filter, like take the CLUE acronym through all the various investments that you have and through all of your cash positions. And that's one of the big hangups that I have with the stock market is it's kind of liquid, but it's kind of an investment. And frankly, it doesn't do either job very well. I would rather people really split their assets and go all after control and liquidity for your cash position, because that's what emergency opportunity money should be, and then be able to use it for whatever you want. And as you're well aware, IRAs, as an example, we cannot use them for whatever we want. We cannot use them whenever we want. And then furthermore, the E for equity, so control, liquidity, use, and equity. E for equity tells us that we want to be able to borrow against things. We want to be able to leverage our assets. And so many people are putting all their money into 401ks, all their money into IRA rollovers because they were in 401ks or 403bs, and they don't have control over that. It's not liquid. They can't use it for whatever they want, and they can't leverage it. And so I'm not saying that IRAs are bad. We help tons of people with self-directed IRAs. I just encourage people to consider before they put new money in them, because we get so focused on the tax deferment that we're getting, right? It's just kicking the can down the road. But we get so focused on that today, and our CPAs are so focused on that today because they're trying to help us now in this year's tax, as you know, they're doing our returns and whatnot. And our society gets confused, and we cannot control, keep liquid, use, or leverage our IRAs. So put money where you can control it, where it is liquid, or obviously some investments are not liquid, but then make sure you have other liquid money so that you can solve emergencies and take advantage of opportunities, which again comes to the use part and the equity part, because as you're well aware, leveraging enables us to take advantage of opportunities, sometimes with very small dollars to get very big opportunities. And we want to be able to use our money like equity. And so that's why the E in CLUE is such a great acronym to help us remember. Just look at it. Use it as an opportunity filter. Can this asset enable me to leverage it?
That's awesome. I appreciate that. One other thing I want to discuss with you is diversity. I want to get your opinion, your take on, being diverse with your investments. Some people just do just private lending, or they just want to do syndications for apartment buildings, or just this one thing, or just rentals. So what is your take, and how do you feel about addressing, having a diversified approach in your investing?
Well, it is a really good question. And diversification is a very common thing that's brought up by typical financial planners. It is, the whole asset allocation and all kinds of fancy software to help you with it. I'm not a fan of typical diversification. However, I'm also not a fan of somebody just going all in on one thing. I just don't think that's wise. So I split money up into 3 categories. Keep it super simple. Cash, right? Liquid money that we can use for emergencies and opportunities. Things that create income, so cash flow, and then things that are there to grow. So cash, income, and growth. And those are the only 3 things that I look at. So when I bring a new client on, I just ask them, well, you have this account. What do you want it to do? Does it need to be cash and be liquid? Does it need to be creating income and cash flow, or does it just need to grow for later? And then from there, you can literally pick just 3 products, each which does that single job very, very well. And sometimes, of course, people need to pick 2 or 3 additional relationships inside one product line just to be wise in terms of diversification, because one of my mantras is go slow, start small. And so, people get excited about investment. My dad, my gosh, I feel so bad about this. My dad got all excited about this investment and put $300,000 in it, which was basically all that his IRA had, and it got lost. And
Wow.
It just breaks my heart. I wasn't aware of it until he'd already written the check. And I was like, you put your whole IRA in there? So I kind of came upon, with that tough lesson, the go slow, start small mantra, which was that the minimum of that investment was $50,000. That's how much he should have put in.
Yeah.
Put it in a little bit at a time. Watch it, look at it, read the online reports, watch the webinars, and then put in more only after you are comfortable.
Yeah, that's a good point. Really appreciate that valuable content that you share with us today. Oh man, this is a really good episode. Another great episode of PFREI, Passion for Real Estate Investments. I'm your host, Fuquan Bilal. You can catch us on all the social media handles. We have a special guest today, Kim Butler, founder of Partners for Prosperity. Kim, give your contact information, how people can reach you if they want to find out more about the whole life and the other products and services that you have.
Yep, best place is the website, partners4prosperity.com.
Appreciate it. This is awesome.